Hi, good morning, good afternoon, everyone. Thank you very much for joining us for our first of the year Home Building Market Intelligence webinar that we do in partnership with Zonda. I'm Jack Mannon, I'm the Director of Brand Marketing, and we've got a full agenda, so I'm gonna continue to progress things quickly here. First and foremost, our standard boilerplate legal about forward-looking statements that are made. We're very lucky to have Ali Wolf on here, and we look forward to hearing what her crystal ball says and what she's seeing in the market. Let me start things off by introducing and welcoming our President of Commercial Operations, Johnny Cope.
Well, good morning, everyone. Thank you so much for calling. Ali, it is always an honor and a pleasure to be a part of any of the events that we get to do with you. And we are so very grateful for you and the Zonda team and helping us always be able to see what's coming with incredible data and insights that are the best in our industry. So it's an honor to have you here today. For everyone on the call, I think the right way to kick this off before we start talking about some really cool capabilities we have is, as we sit in a kind of a flat or down market, we sit in what did we do when the market was great in order to be ready to be able to drive growth and to solve our customer problems and to be more efficient as we move into a different kind of market. Well, in our case, when the market was good, I don't know if it was smart or lucky, but we had quite a few investments in capacity, innovation, capabilities, facilities. Not only do we have the best people, 30,000 of the best team members in our industry, and quite frankly, we're getting those people home safe because our recordable incident rate is down. We're hitting all of our safety goals because our people are focused on taking care of each other. We've got a lot of investments like in our component capacity. We've got over 1.2 billion board feet of component capacity. We're over 600 distribution locations now. Since 2023, in those investments, we've added 30 locations, 24 strategic acquisitions. We've upgraded 59 trust facilities, 21 millwork location enhancements to drive efficiency and try to have the right cost positions for our customers so that they can be more efficient. Over 1,000 new trucks added to our fleet. Our on-time performance is as the best it's ever been at 9.7%. Like kick 97%. We are doing the right things to help drive the business at a time when we have to work together so that we can deliver the right services, installation services, products, innovation, capabilities connected with our customer. And one of the cool ways that we want to represent that for you on the call today is I need to introduce Dennis Candelera, and Dennis drives our digital initiatives. And it is a great way for us to continue to integrate with our customers so that we can be more efficient and help the builders drive their businesses and hit their goals. So I'd like to introduce Dennis Candelera.
Thank you, Johnny. Appreciate being here. Nice to see everybody. Ali, thanks so much for having us on. This is a wonderful time. As Johnny mentioned, my name is Dennis Candelora. I'm the Senior Vice President of Digital Tools here at Builders FirstSource. I've been with the company about 12 years. In the last year, been in this digital role. And it's been a wonderful, wonderful first year in this role. Our company has invested a tremendous amount in our digital capabilities for our internal users and our external customers. And we are just getting warmed up with what we have to offer our customers. If you think about why we're doing this digital investment, why we're investing so much in our technology, it really comes down to our customers, as Johnny mentioned, right? Our customers are demanding it. Our customers need it. They need us to help them solve problems, help them drive efficiencies, productivities, ultimately driving the cost of home ownership down. And that's what the goal of these tools are designed to do. This slide here we created, we call it the gear slide internally, but it's a really easy way to simplify and look at how we are tackling our digital journey and how we are rolling it out both internally and externally. And if you look at the left side of that, you got gears 1 and 2, kind of the darker blue. Really, those focus around what we call the BFS way. How do we do business? How do we transact business? How do our customers gain and view information from their activities with BFS? How do they view job site photos? How do they track deliveries? How do they pay their bills? It's some of the fundamental parts of our business that frankly our industry has been behind on over the years. So we're making a big effort, particularly over the last year and particularly in 2025, of getting our internal folks and our external folks very comfortable with those tools on the left side. And then as we shift gears and we get into 3 and 4, we start looking at our advanced technologies. This is where things get really exciting. Now we're talking about 3D modeling. We're talking tying out that 3D model to 3D estimating. We're talking about BIM coordination, BIM modeling, really unleashing the power of the technology to drive results for our builders and for our customers, and internally, frankly. And then on the far right, gear 5, right, we've got a lot of wild things there. That's where you start getting to AI and the real super advanced technologies as we look forward and get those. But we're really focused on gears 1 through 4 as we sit it here today. And this here is just a quick summary, right? Just a call out that our tools are really built to solve real world problems for our customers and for our internal users. That's what our focus is. So as a result of that, we are constantly checking and adjusting with our builders, understanding what their needs are, what solutions they need from us to help them run their job sites quicker, reduce cycle counts, reduce cycle times on their builds, reduce material inefficiencies, overstocks, understocks, additional delays, VPOs on job sites. All of those things are meant to be solved with our digital technologies. And this just illustrates where some of those pain points might be, how we're addressing them, some of the comments we're getting back from our customers. We've got a wonderful 2025, remainder of 25 planned out for our digital technologies, 2026, 2027 and beyond. Off the charts, excited about what we've got for our customers coming forward. So appreciate all your time today. Look forward to the rest of the podcast.
All right, next up is Mr. Jeff Reddick.
Hey, thanks, Jack. Over the last month or two, guys, everybody has been asking about tariffs. They've been in the news, what's going on, what products are impacted, to what extent are they impacted, and then what is being exempted as things are moving around in this changing environment. What we're throwing up here on this slide today is just a couple snapshots showing the different views of what everybody's seeing out there and what everybody's trying to interpret on the tariff changes. Here at BFS, we are tracking the latest news and trying to keep up with the changing environment to keep the products moving out to your job sites. So some of the things that BFS is working on is we're working with our suppliers. We're helping forecast our needs so that they can get the products here for the right place, the right time, at the right price. We're also asking for verification if a price change does come down because of tariffs. What tariffs is impacting that price? What's driving that change? And we want to see it on paper. And then we're always looking for alternative products out there to keep your job sites moving. Here in the building products and millwork side, we have brought on additional inventory over the last few months. And so we're taking some of that volatility out as we move forward. Some of the key products right now that we're watching on out there has been concentrated in those categories that are solely or partially sourced from China, such as hinges, bath hardware, doorknobs, stair parts, and door sills. In time, we do expect to see price increases in other areas such as exterior fiberglass doors, interior molded doors, cabinets and tops, as well as windows. We're going to keep everybody apprised out there and keep those products flowing to your job site. Thanks for your time, Jack. And now I'm going to turn it over to Matt Lufkin, our VP of Forest Products.
Thanks, Jeff. Good afternoon, everyone. I'm Matt Lufkin. It says Jeff Reddick. I'm the Vice President of Forest Products. Just wanted to touch on, the updated Forest Products outlook as we head into mid Q2 this year in the back half of 2025. With the tariffs controlling the majority of the dialogue in Q1, buying behavior was driven by the fear of tariffs and price increases throughout all species. As we moved out of the first quarter and into April, tariffs were deemed exempt under the USMCA status. And with that, a lot of the mill order files collapsed and price erosion took place. If you look at our industry as a whole, we've seen supply in all wood categories really outpace demand. If you look at most DC ratios by category, so it's demand capacity, they've been extremely weak to the tune of probably sub 80%. As manufacturers look to get these percentages back in a healthier balance, we anticipate seeing continued rolling shutdowns and as well as future indefinite curtailment. So we saw quite a few of them last year, as probably a lot of people on this call are aware of. If those actions don't raise prices to sustainable levels, we could see even further curtailments heading into the fall as CVD and ADD rates are set to more than double. As mentioned above on the slide, that'll take things from 14% to 35% sometime out in the fall. Given these scenarios, we feel there'll be less volatility in the short term as the market tries to find balance with supply and demand. Depending on pricing between now and September, the volatility can accelerate in the back of the year. As we go to the next slide, even given the macroeconomic headwinds we're all facing, BFS continues to invest in growth and innovation. As you can see, we continue to upgrade our truss facilities and add automation to drive efficiencies across our network. We've also opened a new millwork facility in Ocala, Florida, and expanded our capabilities in 3 other operating facilities. We'd also like to remind everyone of some new members we've added this year to the BFS family. You'll see OC Cluss in Pennsylvania, Maryland, and West Virginia, an acquisition of Alpine Lumber in Colorado and New Mexico, and just recently, Truckee Tahoe in Colorado and Nevada. All these investments show our continued commitment to provide excellent service and products to our customers as we prepare for the housing market to recover over the next several years. Looking forward to hearing Allie talk about that. So thanks to everyone for their time. Now I'll pass it over to Allie Wolf, our Chief Economist for Zonda. Thank you.
Awesome. Thanks, Matt. And hello, everyone. I am delighted to be here to go through the state of the housing market and wider economy. Now, the tricky thing is, if you went to BFS's annual conference earlier this year, you know that a lot of things have changed since January. So I don't think any of you will be surprised that as I go through my presentation, we have had to revise some of our expectations. And I'm going to go through a lot in the next 40 minutes. Now, as mentioned, I am Allie Wolf. I'm the Chief Economist with Zonda and New Home Source. If you're not overly familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Now, Zonda is our B2B side of the business, but we also have New Home Source, which is our B2C. Now, New Home Source from a consumer point of view allows consumers to look for new homes, use interactive floor plans and site maps. But from an economist point of view, we are putting together a report right now to say, okay, what do the click trends tell us about where the housing market goes? We know that a lot of the data that we can track from consumer behavior can help us forecast the housing market better. Now, specifically within my role at Zonda, I lead our economics department, which includes all of our published research reports. Today's presentation is based on our National Outlook report. If you're not subscribed to it, you should consider. We go through really anything and everything that relates to the housing market, demographics, policy, the economy across the country. We also have reports on building products, what's happening in the build to rent space, as well as master plans. Now, I said earlier, 40 minutes. We're going to go through 5 sections. We're going to start and spend more time on section 1, the economy, kind of the bigger picture trends than I normally would, just given the backdrop that we're in. From there, we'll apply everything we talk about in 1 to what's happening in the for sale market, what's happening in rental, what are we seeing with remodeling, and then we'll finish with our forecasts. Now, where I want to start is with the idea of trying to forecast where the market is going is tricky when you have key data sets that are giving you incredibly mixed messages. If you think about how to interpret the economy, typically speaking, we have access to hard data and soft data. Now, hard data is objective. How many jobs were added? How many homes were sold? And right now, if I were to give the hard data in the US economy a school grade, I would give it a B. Some of you may disagree because you saw the GDP report come out and you saw that it was negative. But remember that the reason our GDP, so the broadest measure of the economy, report was negative was because we had a rush of imports ahead of the tariffs. If you looked at consumer spending, business spending, it was still positive. We're still adding jobs. As of right now, what we have available to us, I don't think is worse than a B. If you look at the soft data though, soft data is usually collected through surveys. Soft data is usually how people or businesses feel. I would give this a school grade of D. We know that the soft data does not look good today. Consumers are concerned, businesses are concerned, investors can't decide how they feel. Just look at the stock market today. But if you think about consumer confidence, we can get this through a lot of different sources, but the Conference Board has their data that they release that shows consumer confidence currently is at the lowest level it's been since March of 2020. And as consumers say what they think is likely to happen in the future, confidence is at the lowest level it's been in over 12 years. The current index reading is below what is deemed recessionary from the Conference Board. It's not only this, we know 72% of Americans are extremely or very concerned about the US falling into a recession. 55% believe that the economy is getting worse for their family. So high level, and I'm not self-selecting these data points. There were a lot of other sources that I could have used to get us to the same place. Consumers generally do not feel good about where we are right now. Well, what about businesses? I like to look at businesses from a couple different lenses. What do we see from smaller businesses? What do we see from larger businesses? On the smaller business side, we can use the NFIB, which looks at what is happening with hiring plans, with cost plans. What are you thinking about how uncertain the environment is or not? The most recent data from the NFIB on uncertainty came in at the highest level since this organization started tracking the data 52 years ago. Besides that, just more broadly, CEO confidence mirrors what we saw with consumer confidence. The current rating is the lowest level since spring of 2020. The future expectations of where the economy might be going is at the lowest level since 2012. So this is not the best or the most uplifting start to the presentation, but this is just soft data. We said soft and hard data are telling different stories. And the big question I have, and I don't have a direct answer to it, is does the soft data turn into the hard data? There have been times in recent history, since we've been doing these webinars together, BFS and Zonda, that the soft data does not turn into the hard data. It does not have to. I do believe, though, that the evidence is mounting that we will see that soft data actually start to pull down broader economic growth, bring that B grade lower than where we started. But you ask yourself why? Why is the soft data so bad right now? And the answer is simple. It's uncertainty. Consumers are saying, all right, well, what's going to happen with my investments? How volatile is the stock market going to be? Am I going to still have a job 6 months from now? Are my wages going to outpace what we see with inflation? And obviously still just a lot of questions and concerns about interest rates, where they are, what could happen with access to capital, when are they going to ultimately come down? On the business side, there's a lot of focus on sales and margin and where is the growth going to come from? What about regulatory changes? But what comes up most often, and you heard Jeff mention it earlier, is tariffs. Now, I'm not here to talk about what countries are getting hit with what tariff, what input is exempt, what inputs are not exempt, what deals have been made. My big thing is to step back and to say, okay, if we are in a trade war right now, what are the potential outcomes? And I will tell you, there are 3 pretty bad outcomes. There are 3 pretty great outcomes. And we got to see how this ultimately shapes up. But I want to start with the 3 negatives. These are things that we cannot discount in our business. These are the reason we have such high levels of uncertainty. When you have uncertainty, if it lasts long enough, it results in lower spending, it results in slower growth. Slower growth is probably the best outcome here, because if it's not just slower growth, you could see an economy that turns into one that is stagflationary. Probably haven't heard this phrase that much up until this year. Stagflation, put the most simply, is that it is an economy where you have the unemployment rate rising, so you have slower growth, but you also have costs rising. You can imagine, you don't want to be in a stagflationary economy. Another outcome is a recession. This just goes back to point number 1. When you have lower spending, it could either be slower growth or that growth could really go negative. The recession could be domestic, which is a better outcome than if it's global, but we know that everything that we're talking about with the trade war does impact global economies. So there's certainly risks. But what about some of the potential outcomes that are good? Domestic suppliers, this is great. This is helping to encourage more companies to source from within the US. We just released a report this week to our subscribers of our National Outlook report on reshoring or onshoring. We know that through both the Biden administration and the Trump administration, there has been a focus on getting more manufacturing back into the US. We know that there have been some positive signs there. And I think what I'm rooting for the most, and as a general statement, economists, I'm not talking politically, economists don't like tariffs. So point number 6 is what I want to see, is that we do know we have had unfair trade practices with some of our partners. We know that this president is really focused on negotiating, trying to rewrite some of the wrongs that we have in our trade policy. We can see, and we've already seen, a partial or full reversal of some or all of the tariffs. That's really what I'm hoping for, is that we see just a resolution. But the key thing is a resolution quickly. We can't have this drag on too long. The longer it goes on, the longer 1, 2, and 3 become a greater risk. If you think about tariffs from a home building perspective, we asked builders in our survey about how they're viewing it. No surprise, 90% of builders are either slightly or very worried about tariffs. When we ask them explicitly why, their answer will say, well, we're concerned about the impact on housing cost. We're concerned about the impact on housing demand. And we're concerned about the impact on the stock market. I'd say the stock market is just by extension, does that cause uncertainty? Does that ultimately impact demand? But point number 1, nervous about the impact of housing costs makes sense when we already had about 65% of builders that said their total cost of building a home had already gone up this year before we saw the tariffs implemented. Many of you know we have a building product expert named Todd Tomalak. What Todd did is he looked at all of the inputs that go into building a home. He looked at where those inputs were sourced from. He looked at what the tariff rate was, and he collectively was able to come up with a number of what sticks and bricks change will be in response to the tariffs. Now, he does include a baseline inflation rate of 2.5%, but what Todd estimates is about a 9% increase in the building material costs given the tariffs. If you think about this more specifically to what does it mean to the final home price, we can turn to either the NAHB or builders themselves that have estimated that we're looking at $5,000 to $10,000 added to the total cost of the home in response to the tariffs. Tariffs are one of the policies that we know has and can continue to impact our industry. But another big thing that builders are paying attention to is what happens with immigration, what happens to immigration changes. You will see this one's more divided. We said it was a 90-10, builders concerned about tariffs or not. Now we're looking at 70-30, builders concerned about any changes to mass deportations. When you look at the 30% that are saying not worried at all, partly this will be geographic. Builders in the Midwest, for example, shouldn't be worried. Not much of their labor force is undocumented from outside the country. California, Arizona, Texas, Florida, these are the areas where builders should be more nervous. So not only is it geographically dispersed, but one thing that we're hearing from builders is we know that immigration helps fuel our construction labor force, but right now, because housing starts are down, we don't feel that the labor force is so tight that if we see changes in immigration, it's going to impact our business. So the fact that starts are slower is kind of masking the longer term demographic challenges we have with getting new construction workers ready to be able to support the housing industry in the future. So at this point, we've spent 10 minutes just talking about a lot of the volatility, a lot of the uncertainty. But what really matters is how does all of this impact interest rates? Obviously, we care about the economy, we care about jobs added, but we also care about borrowing costs. Well, right now, we have a lot of up and down factors. We have factors that are pushing rates up, pushing rates down. The more prominent force right now are those factors pushing rates up. I would say the reason we're seeing interest rates hold higher, I would attribute it largely to two things. You can see there's a bullet of a lot of other factors. I think it's the fact that inflation is still coming in firm. There's expectations that inflation will be higher as we look further out. And investors are changing where and how they place their money, which is putting upward pressure on borrowing costs. Typically speaking, though, when you have so much economic uncertainty, you should see interest rates go down. It's just those other forces are more powerful right now. Oftentimes we hear people try to root for interest rates coming down. Just remember, you don't want to root too hard because typically interest rates come down in a slower, or a slowing economy. If you've seen me present recently, you know, or you've heard me say this already, but I want to reiterate, there is no one on the planet that knows what is going to happen with mortgage interest rates. And I hate to say it because we all want to have the answers, but there's no one. Because Trump doesn't even know when he goes into these negotiations how much the other countries are going to work with him. If we can't figure out what's going to happen with tariff policy, we cannot figure out what's going to happen with mortgage rate policy. The best that I can give you and what I feel most confident saying is that we're still going to be in an environment where mortgage rates are volatile, and we should expect to see interest rates holding in that higher for longer, which to us means interest rates between 6% and 7%. Now let's tie all of that to what we're seeing in the housing market. And this is where things get interesting. We do still have very different existing and new home markets, but the new home market is definitely shifting more than I think was originally expected. Let's start though with existing home sales. These represent the largest share of total transactions. The purple is what we've seen with the most recent data through March. We are bumping along the bottom. Existing home sales still coming in incredibly weak, down 3% year over year. Now, what stands out to me is that sales are down 3% year over year, despite the fact that listings are up 30%. So you can see the purple line is 2025. We just got April data, so I updated it this morning with the most up-to-date stats. You will find that our listing activity right now is looking pretty in line with where we were in 2020, so just the very early days of the pandemic before we started to see inventory drop off. We are still down 16% from 2019, but you can certainly see as time goes on, we're narrowing the gap between those two numbers. A big shift that happened in April, I haven't seen this since the pandemic started, is we now have more of the top markets that have higher levels of inventory than they had in 2019. So we have 54% of the top markets that have more inventory now than pre-pandemic. We have 46% of the top markets that are still down. If you ask the question, well, which markets? I got it. Here we go. This is showing you the active listing distribution. The darker the purple the dot, the higher the change in listings relative to a more normal market. The key thing you need to know is historically, the past 5-6 years, we've been able to say supply is tight everywhere. Now you really need to talk about it on a local level. What's going on with supply? Well, what market are you talking about? When we look at overall listings, though, the key thing is listings themselves doesn't tell you the full story. Let's use Austin, for example. Austin listings are up 57%. If sales are also up dramatically, then I'm not really paying attention to that because that feels like the market's more in balance. We came from an environment where everywhere was a seller's market. Now, we do still have some areas that are classified as sellers, parts of the West Coast, parts of the Midwest, the Northeast. But we now have more markets that are coming in as balanced. Balanced is typically 4 to 6 months of supply. And even in parts of Florida, we're looking at pretty heavily buyer's markets today. Now, a little word of caution on Florida. We pulled the data, and yes, a lot of the rise in the supply in Florida does come from condos that are going through the reassessment fees following the Surfside collapse. While that is the case, the rise in condo supply is still impacting other housing demand in the market. So it's not happening in isolation, but I do want to make a caveat that part of it is coming down to condo inventory. Now, the reason for me, I care so much about what's happening with the existing home market, I care about what's happening in inventory, is I want to know, well, what's this mean for new home sales? Purple line, 2025. We are now at a point that we're pretty comfortably down from where we were last year. We are now down from where we were in 2023. We are still above where we were in 2019. Now, most of you know I spend a lot of my days just traveling the country, looking at different housing markets. How do they compare and contrast? I always want to try to find a way to describe the housing market that mostly applies to areas across the country. What I would say right now, almost regardless of new versus existing versus anywhere across the country, is we are in a market today that lacks urgency. People may want to buy a home, but when they're looking at the uncertainty, they're just saying, do I need to buy right now? If the answer is you don't need to buy right now, a lot of people are saying, okay, then I won't. I will later, but maybe I won't right now. When we look at new home sales, we like to look at them adjusted for supply and adjusted for seasonality. We do this via what is known as our ZMR or our Zonda market ranking. If you joined our webinars last year, you know that the ZMR was slightly overperforming all of last year. First 3 months of the year, the market has come in as average. This compares the market relative to its history. We have 40% of the top markets that are still overperforming. That will be your green dots. 26 are coming in average and 34% underperforming. Remember though, if you've seen this before, the key thing is all we're doing is counting sales activity. We are not knocking a market if incentives are incredibly prevalent. If it takes the builder offering a lot of money to sell the home, we don't care as long as the home's sold. But we do care, just not in that model. So that's why we want to focus on incentives. Incentives are critical. Incentives are the reason the new home market is still doing better than the resale market. Incentives are everywhere, though you will find higher uses of incentives in the areas that have more resale supply, just in general, more competition. From a builder point of view, we see 3 challenges with the incentives. The first being that they're not driving people off their couch into the community like they were in the past. Incentives are no longer an urgency driver. They're really more of a Band-Aid. If someone comes in and they say, I want to buy a home, and they're saying, but I don't have enough cash to do it, the builder can offer some of those funds to help them purchase the home. But because builders are having to increase the dollar amount, because incentives are so common, we also know incentives become expensive. They become a pretty big hit to margin. The data that we track at Zonda on incentive is project by project across the country. We have the most granular incentive data you can find, but still we will underrepresent it because builders will still have their pocket incentives that they won't advertise, that they won't tell us on the phone. They'll only offer on a consumer by consumer basis. So know that our numbers are always going to underrepresent reality. But the big change, even since just the beginning of this year, is in the past, consumers would come and they'd see a mortgage rate buy down and they say, great, love it, I'll take it. Now what consumers are saying, well, they'll say, a buy down, is that it? Can't you do something else? Can't you give me a design credit? Can't you give me funds towards closing costs? What about price changing? We do know that price changing has become much more common in today's market where builders are willing and able to lower their prices if they need to. This map is showing you the change in prices from where we were in the peak of the market. Of course, the new home market is always going to be susceptible to mix shift, meaning if builders are building smaller homes, that could also bring the price down. But we account for that because we have our builder survey, our soft data, if you will. The map is showing you hard data. Soft data backs it up, which is 35% of builders said in April they lowered prices from March. That's just one point in time. If you collectively looked at the year, a lot of builders will tell you that they have had to at least lower prices a little bit to see if it is driving any more interest. We asked builders in our most recent survey to rate the market on a scale of 1 to 10. We asked them to rate it today, where we were this time last year, where we'll be 6 months from now. So this time last year, builders said the market was a 7 to 8 out of 10. Remember, the ZMR said it was slightly overperforming. That tracks. Currently, builders have lowered it. They've moved it to a 5 to 6 market. Again, ZMR says the market's average. That tracks. What about the future? I find this perplexing. Builders think 6 months from now, the market is going to be 6 to 7. So somewhere in between where we are today and where we were a year ago. My biggest explanation here is them saying there's probably going to be some of that uncertainty that becomes resolved. We probably get to a market that just feels a little bit more stable. And so maybe we don't have as much enthusiasm as last year, but people aren't as frozen or as scared as where they are today. So that brings us through what we've seen in the economy, what we've seen in the for sale space. Let's now turn the discussion to the rental market. Now remember, the key story in the rental market, in the multifamily world, is what you're seeing with those high bars in 2024. Deliveries, deliveries, deliveries. There were a lot of units under construction over the past few years. They all were getting completed right around the same time. There was a lot of supply that was hitting the market. This caused a lot of angst. This caused a lot of competition. This caused a lot of developers to pause on new starts because they wanted to work through what was already in the market. As you can see, our belief, and we also grabbed this from JPI, our belief is that we're past that peak level of deliveries. We are going to see deliveries come down. We do still expect 2025 to be a high year of deliveries, kind of falling off a cliff as you go into 2027. So it's true. Everything I said, that has been the concern. There have been a lot of supplies. There has been a lot of concern. But the interesting thing is supply doesn't happen in a vacuum. You also want to look at what's happening with demand. And apartment demand has been exceptionally strong. This is showing you first quarters going back 25 years, and we've seen the strongest first quarter of apartment demand during this whole time period. This is partly because maybe someone is moving out after recoupling with someone. We know part of it is that people aren't leaving units like they were in the past. People are not moving out to buy homes, so you're finding that there's still just a steady level of people staying within their apartments or moving into new apartments. What developers care about though is, okay, how do we then combine those two slides? How do we combine what's happening with supply and demand? Well, we can look at occupancy. Of the units that are there right now, what is happening with occupancy? If you remember, at the beginning of this year, but even last year, occupancy was looking bad in a lot of the Sunbelt markets. It was looking low. Typically speaking, developers want to have their communities at 95% occupancy. You're finding that in our regional clusters. You're finding that 95% West Coast, Midwest, Northeast. We're still below that ideal threshold in the markets where we saw the most supply, where we still need to work through that supply. With all of that being said, these numbers are still below the threshold. They look much better than they did 6 months ago. So because that demand has been strong, we've seen occupancy look better, which is important to seeing a market that looks more stabilized. It hasn't fully shown up in starts yet, and we don't think it will see a rapid rebound for a while. But if you look at overall housing starts, we know we've been coming in below that 400,000. Supply backdrop, because they're still just working through the overhang, we haven't seen starts rise. We did have to update our forecast though. And I will say uncertainty is probably the word. I think people counted how many times Jerome Powell said it yesterday. I'm probably competing with him of how many times I use the same word. We revised our forecast up mostly because our original forecast was below what we're seeing come out in reality. And so we're just kind of getting back in line with what we're seeing from the census. We also are revising it up slightly because demand has been strong enough. 7% sounds like it's a lot of growth, but remember that's 7% from the trough of the market. 360,000 still not putting us at a very strong or very robust market. I think we'll talk a little bit later in the Q&A about the multifamily market, so we can hit on a little bit more there. But I want to turn the discussion to the remodeling space. Now, I had mentioned earlier we have published research. Todd is, if you haven't met him, he hates when I say this, but he's a genius. He just knows how to look at data. He knows how to interpret data. He knows all these alternative data sources, and he releases it in our Building Products Outlook report. What I'm going to go through on the next couple of slides are Todd's most recent forecast that he released to our clients on April 30th. It is a lower forecast than what we've been saying. I don't think anyone on this call should be surprised though, just given everything that we've already talked about in the first 25 minutes. But I want to step back. Todd has not changed his thesis. His thesis has been and continues to be that idea of holding that water, the ball underwater. You're holding a ball underwater, you're holding it, you're holding it, you're holding it. The second you take your hand off, the second the ball goes back up to the top of the water. He still believes that narrative. He still has research to back that. He calls it the deferral then rebound. But things have been more complicated than he originally thought just because of tariffs. Now, Todd goes back. He's an economic historian. He likes to look at what points in time most align with what we're seeing on the ground today. I know there's a lot on this chart. I'm going to use colors to get your eyes to the right place. The yellow, if you're not colorblind, if you are, sorry. The yellow is going to give you what Todd thinks is the best example of what our remodeling space is going to look like. The yellow is what we saw during the last time we talked about stagflation, which was the late 70s, early 80s. You see a drop off in remodeling activity, lift the hand, remodeling activity goes up. Todd normally and historically does one forecast. The forecast is our baseline forecast. You can see that as the black line here. Todd has had so many clients reach out that say, I love the baseline forecast, I want it, but what about? There's no tariff resolution. How does this change? What if we do not see? What if it's not point number 6 earlier, that this is just a great negotiating tool? What if these are sticking? Well, you can see Todd has a much more steep and a prolonged drop in the remodeling activity before he captures the rebound. He captures the growth rate of that rebound much less pronounced. What if 70% of the tariffs are resolved? What if the market does get past this point of uncertainty? Compare out the purple line to the black. Well, now he's saying we'll probably hit the same bottom, maybe finish it a quarter earlier, but a more rapid rebound in the market. This specifically shows how Todd is looking at remodeling spend on a year-over-year basis. And our original forecast had that growth towards the end of 2025. Todd said, okay, we believe this is the theory. We believe the market's going to come back. He's had to push that out just because of the uncertainty, because of the tariffs, because of the higher costs. It's just a lot less likely that we're going to see a rapid growth this year, more looking into 2026. Todd, I think it's a 46-page report on his forecast where he breaks this out by product type, where he breaks this out by input component. But here, what I pulled from his report is the remodeling spend by product type. So is it a big project? Is it a mid-range project? Is it maintenance or repair? You can see the period is on the left of this table. He's looking at basically maintenance and repair. You can only defer it for so long. He thinks that's going to be fairly consistent. He thinks that we see a more rapid and pronounced uptick in the big projects. You can see that starting second quarter of 2026, a much more slow and tempered rebound when you look at the mid-range space. So we've gone through a lot here. I've given you our updated forecast on multifamily. I've given you our updated forecast on remodeling. How about single family? Okay, so let's start by talking about how the builders have thought about starts throughout this year. So this is showing our builder survey. The way that we model at Zonda is we have three things. One, we talk to builders. We use that as qualitative input. Two, Todd and I are on the road every week. We're talking to builders. We're getting the insights. That's another piece of qualitative data we want to use. Three, we have a model. The model helps us forecast housing starts. What the model spits out sometimes doesn't match 1 and 2. Maybe the model says 10% growth, but builders are saying starts going to be down. Well, we're not going to go with just a model. Math can only get you so far. Then you have to apply reality. So again, one of our inputs is what builders are saying about housing starts. In January, the highest share of the responses were that builders were anticipating starts were going to be up more than 10% compared to where we were last year. By April, our highest share of responses is builders expecting that starts will be roughly the same compared to where we were last year. Nationally, our breakout is about 50% of builders think starts will be flat to down, 50% think starts will be up. This is now applying what builders are saying to actual data. If you follow me on LinkedIn, you know that I posted this. Zonda is the only company that can give you this information. So being able to tell you what is happening with actual housing starts that we've visually verified across the country. This shows you the top 25 production markets. No change in the top 3. Still, Dallas, Houston, Phoenix are our biggest areas. But I want to draw your eye to the year-over-year change. So we said 50% of builders saying flat to down, 50% saying starts are up. To start the year, that is almost in line with reality. We have 40% of the top markets that already have seen starts down, 60% that still have starts up. I do believe over time we're going to see these numbers increasingly turn negative unless demand turns around and we start to see this positive shift. When I posted this, I will say I was focused on the year-over-year change. I wasn't focused as much on the market. Someone, when I posted this online, said, wow, when you look at the markets that are down, they're almost all concentrated in Florida, or at least all the Florida markets shown here have posted a decline. We've talked about this before. We flagged some of our concerns with Florida. We know that just what is happening with supply, what's happening with insurance costs is starting to play into the market, slowing housing demand, as a result, slowing new housing starts. So all of that is what we're seeing with starts activity. Now I want to go into trying to forecast the future. So when I met with you all in January, our base case forecast was 2.5% growth in single family housing starts. We base this on 2 key things. Number 1, we track land and lot supply. For a long time, builders were saying land and lot supply was holding them back from starting new homes. Land and lot supply is now at the highest level we've seen in the past handful of years. We just released a report today on lot supply. You can find it on zondahome.com. It's free. It shows you the trends that we're seeing in land and lot. So we said, okay, the land is there for builders to start new homes. Community count is low. Community count is anywhere where there are 5 or more units for sale. I'm going to just use San Diego as an example. In San Diego, there are 62% fewer actively selling new home projects than just 2019. We knew that these numbers were low, and we knew from the builders on their earnings calls, they were explicitly saying, we are going to increase our community count. This is going to drive higher levels of starts. For us, those 2, good. If we roll that together, we didn't think it was going to be a crazy good year for sales, but we felt like there was enough on the supply side to support a little bit of growth. What has played out in reality is, yes, land and lot supply looks better, but builders still report lot delivery delays. They still report frustrations with local municipalities. And the fact that demand is coming down is just not giving them the confidence to be aggressive with new starts. So builders have changed their tune on how aggressive are we going to be. You saw that in our survey. As a result, we have decided to lower our forecast. One thing that I am incredibly proud of at Zonda is we are not trying to be first. We're not trying to be we want to catch the headlines. We want to do a dramatic splash. We want to get it right. We want to feel like we've really done our research. We've really studied everything that we can, and we don't want to cause whiplash when we change our forecast. We want to be more stable. I have communicated verbally for a while that our forecast was wrong. We just hadn't officially come out and said it. We have revised our forecast down now to -5% single family housing starts. Could we be wrong? Absolutely. I would almost bet on it. In this high level of uncertainty, we're not going to get it right. Directionally, I think the market is proving that starts are going to be down. We could see a more dramatic drop if tariffs hold, if consumers pull back, if those points 1, 2, and 3 about the risks start to play out in reality. We could be wrong if, builders think the market's going to look a little bit better 6 months from now. We wake up tomorrow and our president says, you know what, we got a lot of negotiation. We feel like we want to stabilize the economy. Never mind. I think that would push the stock market up. That would push a lot of consumers out from being concerned about the market. For us, though, the evidence was just mounting that there's just enough factors pulling back the market, whether it's builders not being as aggressive with new starts, whether it's the challenges we've seen in parts of Texas and Florida, Arizona as well, just some of the Carolinas, which has been really a standout star. You're just starting to see some of the markets that have done really well not be as strong. The revised expectations from builders and just the concern that builders have to be really aggressive with incentives. They're having to cut pricing, but we also think that their costs are going to go up. And just how do you balance that out if you cannot continue to raise prices to offset the cost increases? Ultimately, as we look at the backdrop, we expected the market to be bumpy. We expected it to be bumpier than we thought it was, but I think there's still a lot of reasons that I feel enthusiastic and positive about having to do our research and finding kind of the ways to stand out. But there's still a lot of reasons to love housing, in particular new housing in the US. The first comes down to demographics. Let's go through the 4 key demographic groups. Gen Z. Gen Z has a very low homeownership rate. They're very young. They want to buy homes. They've communicated it early. They're trying to put some steps forward to put savings aside now to purchase a home. A big demographic cohort that's coming in. Not huge, not as big as the millennials, but still important. Millennials, you have a mix of first-time buyers and move-up buyers, but they're going through a lot of changes. When they get married, they now have 2 incomes. As they get promotions and they move up the corporate ladder, affordability is less of a concern than it would be for Gen Z. Gen X, the love and forgotten generation. No one ever talks about Gen X. They're not very big in terms of sheer population, but they are moving now because they're starting to get to the point that the older Gen X's are getting into that 55 plus. They're getting closer to retirement. They're evaluating their life stages. And the baby boomers have become the #1 most active buyer. The baby boomers do and have pulled back because of uncertainty. The baby boomers, their wealth is still crazy high, even if it's down a little bit compared to the beginning of this year. The second we get higher levels of uncertainty, that group's going to come back into the market. I feel very, very confident about that. The new home market still has an advantage relative to the existing home market. New homes used to be 20% plus more expensive than resales. Now we're down to 3%. Yes, it's partly because of changes in supply and location. It still matters. This still matters when someone's saying, what do I want to buy? Do I want to buy an old home that's expensive? Or do I want to buy a new home that's also expensive, but at least the builder's giving me some incentives and the math makes sense. When you ask consumers why they buy new homes, it's because they want to avoid problems, which becomes a really big selling point when our housing stock is the oldest it's ever been on record. And they buy new homes because they want to customize and design. That's not going to change. We do still think that's a factor. We've seen that builders are trying to figure out what can they do that makes their project look unique or stand out. New homes will have lower insurance costs than existing homes. So even in parts of Florida where we talk a lot about insurance costs, when people can get access to insurance and they compare out, should I buy a new or resale home? It does typically, what's happening with insurance costs filters them into the new home space. And the final thing I'll say here is we just finished 3 days at Zonda's Builder 100 event. It's our staple event of the year. The largest builders in the country attend it. And while everything I said was, it was backed up by the conversations, by the panels. I gave a presentation. There was nothing that was like, I completely disagree with that. The big thing that came up is, even if we talk about Texas or talk about Florida or we talk about Orlando, the housing market is hyper local. We haven't had to be as data reliant as figuring out exactly where the opportunities were in the past, because opportunities were everywhere. I think we still have those opportunities. It just takes more digging and it takes more work to ultimately figure out how we can still be successful in today's market. So with that, I believe we have about 9 minutes to get through questions. So Jack, let me turn it to you.
You bet. Well done, Allie. Let's give a silent round of applause for Allie here and let her catch her breath for a moment while we open up Q&A with 8 minutes left. So let me ask the first one that's been repeated several times. Will there be a copy of this presentation available after the webinar? Certainly. In the next 24 hours, a link will be provided that allows you to download not only a PDF of the presentation, but of the recording itself. All right. Next up, giving Allie a break on her vocal cords there. Let's go to Matt. Matt, are you there?
I am.
All right, here we go. I see that several mills have been taking rolling shutdowns. Do you think this will move to indefinite curtailments? How could this impact pricing?
Good question. Obviously, one way of answering that is if demand were to rally back and overtake capacity, then the answer would be no. But I think we just heard, Allie mentioned that their forecast is down 5% year over year. I think ours is much of the same. It also depends on species. If you look at the slide deck we built together, I think that on the lumber side of things, we're probably going to see more curtailments starting in an indefinite matter, probably in the next 90 to 120 days. I mean, as we go to the countervailing and anti-dumping duties, we know that there's a rise coming there in price. And if you look at the mills, I mean, they have it's what's called a cash cost point of indifference, where they're not going to continue to run when they're just receiving POs that put them in the red. So, again, it depends on if it's the lumber side. I think the answer is 100% yes, we will see indefinite curtailments like we did last year. That's always a big decision because restarting the mills takes a long time. If you look at the OSB side of the world in panels, they have the ability to maneuver a little bit easier on, moving to a 5-2 shift or to a 7-on, 7-off and ways to get around it, hoping that they can make it to the bridge of where the housing market comes back. So ultimately, to answer the question, I think it's yes. It'll just vary by species.
Terrific. Thank you very much, Matt. Next one, here's a quick one for Jeff. A quick one. Jeff, how are the tariffs impacting freight and logistics?
Oh, great question, Jack. I was recently talking to Eric Woods and Ben West, who run our fleet and logistics group here at BFS, and they told me initially when all the chaos of the tariffs started coming out, they did see some tightening on the availability of flatbeds in the U.S. As you can imagine, a lot of retailers were trying to move their material as fast as they can to avoid the tariff deadlines and everything. With lack of availability, pricing did go up. But as things have kind of calmed down, or people are taking, I guess, more of a wait and see approach, the availability has freed up. And we believe that over time, the pricing will also follow suit and free up a little bit as well. We're starting to see some cancelings on maritime containers coming from overseas because a lot of companies probably are starting to move away from purchasing overseas because of the impending tariff impact. So we're watching it. We're watching it from a distance right now, but at the moment we are seeing it lessen or the availability free up a little bit and come back more in line, Jack.
Terrific. Thank you very much, Jeff. Okay, here's one for Dennis. This is a great one. I'd be curious what market this person is in. Dennis, as a small builder, how do I find out more about BFS digital tools and whether they be right for me?
Yeah, awesome question, Jack. I would tell you we've got a couple ways, right? First and foremost, I would start with your sales rep, whether it's an outside sales rep, inside sales rep, key account manager, whoever your primary contact is at BFS. That's the first place to start. Another method that we have is if you're a current user of our mybldr.com platform, when you log into your account in the upper right-hand corner, we have a contact BFS button. You can fill that out and that will directly connect you to your BFS sales rep on record for your account. So we've got a couple methods, to reach our folks, and I would always start with your primary contact that you have at BFS, likely an outside sales rep.
Terrific. Thank you, Dennis. And now to Miss Allie Wolf. Allie, I've sent you a couple questions here in the background for you to go through. We've got about 3 or 4 minutes left here. So dealer's choice.
Awesome. I think I will go with the question on tighter borders and just a question of how would that impact the real estate market besides just changes to the construction labor force. So that's a big question and one that we're hearing come up from big builders more often, which is the idea of, okay, we're spending so much of our time talking about undocumented workers, but we also need to think about our housing demand and where a lot of the housing demand stems from. One of the biggest builders in the country came out and said for the first time in their book ever, the majority of their buyers were non-white. This does not mean that they're all immigrants. It could be a non-white individual born in the US, but if we're assuming some of these people came from outside of the country, there's definitely concerns about, is there going to be a pullback in any kind of housing demand? The areas we would be watching the closest there would be Florida, Texas, Washington State, California, New York. There's going to be more areas that will be impacted by this than others. There's been a change from the Federal Housing Administration on access to loans for people that are not a permanent residence here. And again, a different builder said that they're going to their backlog and they're going to see a massive jump in cancellations because they have a lot of buyers that are on a visa. And if they can't get their loan, they can't buy a house. And so they're very concerned about visa changes. And then the last thing I would say is I'm just watching any kind of changes in tourism. There's been a dramatic drop off in people from Europe or Canada wanting to buy homes. I should have said Arizona. Arizona will get impacted too because there's a lot of Canadians that go to Arizona to buy homes. But if we see a big, and we already have seen a big dramatic change in a drop in tourism from other countries, that can have an impact on the wider economy and can contribute to some of the risks we talked about earlier.
Terrific. Okay, I think that is going to bring us to time here, right here at the top of the hour. Just want to thank everyone for joining. Want to say there will be another one upcoming here in the summertime. But without further ado, I'd like to turn it over to Johnny Cope for a closing remark. Johnny?
Hey, Allie, we work real hard to, integrate, understand the challenges of our customers, and you help us paint the picture, the appropriate picture, in order to make sure that we're allocating our resources the right way. And we're very grateful that not only that you're part of our industry and that you guys continue to invest in ways that allow us to understand what's coming, but just your how. You're amazing, and we appreciate you spending this time with our team and our customers.
Awesome. Thanks, Johnny. Thanks, BFS team.
Thank you, guys. Have a wonderful day.